we have to figure out where the bottom of the Dow is going to be. At one point, I say, look, man, in reality, the bottom of the Dow is probably 8,000. Dow 8,000 is probably something realistic. And we're at what now? Dow 50,000? It's incredible. So, Dow 8,000 to me means probably a 2-to-1 gold. I used to say 1-to-1 that would be, let's say 8,000, but that's already there. We're not there yet, but that's already, I say, a no-brainer. 2 times the Dow, I think, is more likely in this kind of a situation, and maybe even more than that. And then with regard to silver, we could probably hit a 10-to-1. So, it's an incredible thing to witness. It's going to play out that way. But again, that's going to preserve people's wealth, at least putting it in an asset that is real money, has been real money since time immemorial. It's not going to stop. But it's all predicated against the debt market right now, which is a time bomb. It's going to go off. It's just a matter of where. But then we're going to run into a whole new stack of things once the credit event hits. And I think it's a mathematical certainty, because that's what was going on during the financial crisis here. The credit markets were locking up.
Right.
But this time they'll lock up much, much worse.
The warning is that the debt market, not daily stock headlines, is the real pressure point. If credit freezes, the market damage could be far larger than most investors are prepared to accept. Gregory Mannarino, a market commentator known for his focus on debt expansion, central bank policy, precious metals, and market risk, argues that current asset prices should be viewed in the context of the bond market's instability and the long decline of the dollar system. The central prediction is severe. The Dow could eventually fall toward 8,000 from levels near 50,000 if the debt bubble breaks. In that kind of reset, gold could trade at 2 times the Dow, while silver could deliver even stronger relative performance because it remains deeply undervalued. Short-term weakness in metals is still possible if margin calls force institutions to sell whatever has liquidity. But that kind of selling would likely create a major buying opportunity in gold, silver, platinum, palladium, and other real assets. The point is not to fear every pullback, but to recognize where wealth may migrate when confidence in debt snaps. Now, we present the clips from Gregory Mannarino's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
We want a system to work for the people. We need to return. You want to fix the system? It starts with one thing, at least in this kind of environment. Yes, going back to a gold standard would be the best way to do it. But to return purchasing power to the currency. But what would that mean? That would mean we need to vastly or vulgarize the debt market. What would that do to the stock market? It'd be cut in half. Be cut in half overnight.
Probably more than that.
More than that. Who owns 90+% of the stock market? Go back again. 1 and 2%. They can't be allowed to lose. And they'll be the ones out the door first. And today, we're going to get a big tell from NVIDIA and seeing where the debt market's going to go. Right now, bond yields are lower. Someone out there is buying a lot of debt. I'm going to give you one guess who is. I think you already know. It's the Fed Treasury complex, man. They have it cornered. They have the debt market absolutely cornered. I say they have it in checkmate. No one wants our debt. The world is de-dollarizing. They had to establish this merger between the Federal Reserve and the Treasury here. And the Treasury, since what they're doing is unbelievable. They're buying back their own debt that they're selling with cash provided by the Federal Reserve. The system is so upside down and so twisted right now. And this is another reason why people load up on gold and silver. I say this too. Let's put something else together. I believe that the market right now, we're at an inflection point. If in fact bond yields continue to rise, it's going to hit the stock market like a freight train. That would cause gold and silver prices to initially fall on, again, what? Margin calls. And institutional investors saying, okay, we need to raise capital now. They're selling what they can, not what they want.
Thank you.
So there may be a really, really good opportunity here for people to load up on gold and silver coming. And it all depends on where the debt market goes, or if the bond vigilantes show up or something along those lines, however they're going to frame it. But that's what's happening here. And I mean, it's exactly what we said would happen, and it's happening. It's an incredible thing. I look back at stuff that people like you and me and stuff have spoken about. Again, it's not that we're psychic. It's just that we pay attention. And then you don't even have to pay that much attention, just a little bit. And then everything just kind of goes poof. It's just like, when you hit that moment of like, wow, man, this is actually what's going on. But the bottom line is people are going to get squeezed harder. And then maybe they'll say, well, maybe I should start, getting out of the dollar system into a sovereign system, their own, owning gold and silver and platinum and palladium. I still say silver is the most undervalued asset on earth. And I look at it from this perspective is we have to figure out just one thing, one very basic thing. Where's the Dow? Where's the true Dow? I say the market right now is 6 to 7 to 8 times overvalued. So just if we do the math, yeah, it's unbelievable. Based on what got us here? Currency devaluation, artificially suppressed rates, best debt expansion, can't go on forever. So we have to figure out where the bottom of the Dow is going to be. At one point, I say, look, man, in reality, the bottom of the Dow is probably 8,000. Dow 8,000 is probably something realistic. And we're at what now? Dow 50,000? It's incredible. So, Dow 8,000 to me means probably a 2-to-1 gold. I used to say 1-to-1 that would be, let's say 8,000, but that's already there. We're not there yet, but that's already, I say, a no-brainer. 2 times the Dow, I think, is more likely in this kind of a situation, and maybe even more than that. And then with regard to silver, we could probably hit a 10-to-1. So, it's an incredible thing to witness. It's going to play out that way. But again, that's going to preserve people's wealth, at least putting it in an asset that is real money, has been real money since time immemorial. Is not going to stop. But it's all predicated against the debt market right now, which is a time bomb. It's going to go off. It's just a matter of where.
The debt market is described as a time bomb because the world is de-dollarizing while the Fed Treasury complex tries to keep demand alive by monetizing and buying debt. If yields keep rising, stocks could be hit hard, especially because big technology and AI names are holding up so much of the market. A sudden rise in yields could trigger forced selling across risk assets. Gold and silver might initially fall with everything else, not because their long-term case is broken, but because leveraged investors would need cash. That is why any metal sell-off during a credit scare should be treated differently from ordinary weakness. The better focus is purchasing power, not short-term paper price swings, and the better response is preparation before liquidity disappears. Real assets matter most when credit stops flowing, and confidence becomes scarce across markets under pressure. Now, let's get back to the interview.
The bond market is a time bomb. It's been a time bomb for the longest time. We're starting to see the long end of the curve come up here. We haven't seen this convergence that we're witnessing right now since just prior to the financial crisis. It's going to go. It's sending us a warning here. Look, there's going to be a lot more effort, I think, to try to contain it. It won't be contained. They're going to continue to pressure the currency. They're going to continue to buy debt, monetize it. Could it push the stock market higher? We're going to get a real test today. Because we got NVIDIA coming out, which is kind of like the high priest of like AI tech. You got the tech sector, big tech really, is supporting the entire market. And if that were to give way, it would be like, it's the spine. It would be like a bag of bones hitting the floor. So we'll have to see. And even with that, let's say, the earning report comes out about 4:30 or so. And then the conference calls maybe a half an hour after. That's how it generally works. Then we got, it depends on what's happening. You got the debt market today with a little bit of relief. We heard a couple of frank pieces of propaganda today from our president that Iran wants to deal badly. Then Iran comes back saying we're going to expand the war. They don't want to deal. They've turned down everything. Or they come back with a list of demands here. But the market loves to hear this kind of stuff. Crude oil's down like 5% last time we looked at it today. It's just relief. It's headline relief. It's not anything undramatic on it. But that market is the key to everything. You know that better than anybody here, man. There's very few
100%.
people on this planet, and I mean that. You're one of them, who gets it, the fact that this entire illusion is built upon oceans of debt, and this thing is detonating. Aren't we seeing it right now in our daily lives, how the currency is devaluing rapidly, the price action of here precious metals, even though they've gone down as recently. But why is that? That's margin calls. That's this over-leveraged market. It's on a knife's edge. So what happens is investors, they're playing the paper market. They got to dump paper to raise capital, and it hits. And it's a gift, as you know. It's a gift, and I don't care what the price action here of gold is. I don't think about it. Neither do you. The price action of gold or silver or any of the metals, platinum, palladium, copper, all of them. I own them all. I don't think about what they're going to do day to day, month to month. I don't at all. My entire thesis is predicated on basically what yours is too. That is that we are going to reach a moment where things become extremely real. You can't exist in an environment where perpetual debt expansion, and which must expand exponentially on a planetary level, is just going to go on infinitely without there being a price to pay. And there's another facet to this, man, that people aren't even thinking about right now. Going back to the bond market, the bond vigilantes. Basically, the concept of bond vigilantes is a refusal. Well, now we have the Fed Treasury complex buying it all, so this could throw a little bit of a monkey wrench in this scenario here. Let's say, for example, at the current yield, people say, no, we're not buying here. Well, you could see this really take off, and you could see bond yields spike. And that would hit the stock market extremely hard. But, we'll have to see where this goes. The whole thing is such an illusion. It is so fake. And what are we doing? What have you and me and everyone else who gets it been doing since time immemorial? That's what it seems like here, taking advantage of the situation around us, because that's the gift that we've been given.
Yeah.
And it'll stop when it stops. What do we know? I mean, I could go on. I could talk about the bond market from now until the next, solar year without stopping. But going on with the bond market here, it's a disaster area waiting to happen. And it's not about a market crash that what we're really worried about here. It's, first of all, we're in I don't even think it's the late stages. I'm going to say the middle stages of the greatest wealth transfer effect the world has ever seen. Who wins when the currency is weakened? When you hear our president say we need a weaker dollar, well, it's the 1% and 2% is via the Cantillon effect. The way cash moves through the system. Who has access to new money? Cash here. First, it's the entrepreneur class. It's the rich class. Then they get it before it's devalued, and it comes down to us here, people on the ground. And so keeping the dollar weaker, that helps them. It certainly doesn't help us or our way of life or our cost of living here. Artificially suppressed rates here. Yeah, it's the same mechanism. Keep rates artificially suppressed. It kills the currency. And that's obviously the bottom line here. We're watching the dollar die. And you and I and the people that follow our work, I believe we have done really, look, man, I'm not tooting our horns here, but we've done one heck of a job keeping our people ahead of the curve on all this. And people can look at our work, go back to the beginning. And we've been saying the same thing. It doesn't change. People like you and me and the people that follow our work, we're right here. So we don't have to waver. We don't have to think about changing our strategy, because we've been spot on since day one.
Right.
It's amazing. It's a beautiful thing to witness. But, the debt market here, it's going to go off. I'm not saying it's going to go off right now, but this convergence or divergence, should I say, that we haven't seen here with regard to the long end of the yield curve and the stock market and the way actually it's way worse. You can't even compare, in my opinion. I'd love to hear yours. The dynamics that are in play right now between the financial crisis here that was contained. You remember Bernanke was contained, and it did go worldwide and global. He knew it was going there. Henceforth, why rushing to Washington over there and telling our representatives, they don't represent nobody, that if they don't start pumping billions into the system, we won't have an economy. The market is one thing, and that's what everyone is looking at, but it's the debt market implosion that's going to cause what I'm saying is a credit event where everything is just going to lock up and transactions stop. What do we know? I know I'm rambling on here, but I'm going to stop in a second. But the backbone of the system is the flow of credit or the flow of debt through the system. Once that becomes impinged, well, all transactions stop. Zeros across the bank account. But you can't transact in that currency anymore. So we need to build an alternative currency. I say still, and as you would too, is we need to go back to a gold-backed system, but that would return power to the people. A lot of people will argue, well, why not silver, Greg? Well, because gold is the most stable asset on earth, period. There's nothing that even comes close to it. So silver is great, but it's extremely volatile. Okay. But being that, the pipeline is already set up here with the rules, the regulations, bringing us into a, with the Genius Act signing in July, I call it the return of the company store model. How private corporations are going to be able to issue their own stable coins back to one with the dollar, overseen by the Federal Reserve. I mean, you can't make that up. If people try to, even in science fiction, They
Yeah.
couldn't make it up.
The deeper argument is that the current system depends on endless debt expansion and a weaker currency, which benefits those closest to new money while raising costs for everyone else. Artificially suppressed rates, debt monetization, and currency devaluation may keep markets levitated for a while, but they also make the final credit event more dangerous. Once credit flow is impaired, transactions can freeze, confidence can disappear quickly, and the dollar-based system can lose practical usefulness for ordinary people. That is why a return to sound money is presented as the real solution. Gold is viewed as the most stable monetary anchor, while silver is powerful but more volatile. A gold-backed system would restore discipline and purchasing power, but it would also require a painful repricing of stocks, bonds, and debt. The likely path is not smooth. Authorities may push stablecoins, private digital money, and more control first. Still, the long-term prediction remains clear. Real money becomes more valuable as trust in debt, paper claims, and managed currencies breaks down. Owning metals is therefore less about trading and more about exiting a system built on promises that may fail under stress, exactly when protection matters most during the next crisis cycle. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.